So what exactly is a mortgage, and is it the same thing as a home loan? In most cases, the two are very interchangeable, and frankly, they're almost overlap entirely. But there are a few differences and a few things you need to be aware of. And in this video, we're going to talk a little bit about the difference between a home loan and a mortgage and what that really means. You've probably heard mortgage hundreds of times. You probably heard home loans hundreds of times, and you're probably like, Paris, seriously? They're the exact same thing. And that's what I thought as well until I did a little bit more research. And you're going to want to watch to the end where I discuss the different types of mortgages and home loans so that you can actually pick the best one for you in your situation. My name is Paris Cluff. I'm a former financial advisor turned educator and coach, and now I love helping people manage, protect, and grow their money, turning their income into wealth and building, massive bank accounts. So in this video, we're going to talk about the difference between a mortgage and a home loan. So a mortgage is traditionally the amount of money that you take out to be able to purchase a home, unless you've got wads of cash or heaps of money laying around to be able to buy a house yourself. You borrow the money from a bank, credit union, lender of some kind, and then there's terms to pay that back, 15, 20, or 30 years. So here's a key difference between a mortgage and a home loan. A mortgage is actually the contract that allows the lender to have your house as collateral if you miss any payments on that. Not all home loans have the house as collateral, but a mortgage does. So that's the key differentiator, is which one of those puts you at the most risk and which one you're getting into as you're buying that new house. In plain English, the mortgage is the contract and the home loan is the money. When you put the two together, you get to buy a house or a home, and you get to have that home and you have the terms and you pay that thing off. Now, I'm going to share with you in a minute, the word mortgage has a very interesting etymology. Etymology is the study of words and how they formed over the course of history. And I think you'll find this quite intriguing. But before I do, are you looking to buy a house right now? Are you going to get a mortgage, a home loan, a home equity line of credit? What are you going to get to buy your house? Are you building a house? Are you buying a new construction? Or are you buying something that's been on the market for many, many years, and you're just purchasing this now for the first time? Are you a first-time home buyer? Love to interact with you in the comments below. So give me some comments where you are right now. If you're looking to buy a home for the first time, or if this is going to be an upgrade or a downgrade for you, and a second or third, or maybe even fourth or fifth home you've purchased. I'd love to hear more about where you are on your journey in buying a house, getting a mortgage, getting a home loan, and how this all, and why you're watching this video. Just a real quick review on different types of mortgages. So there's a fixed rate mortgage, which means that you have the same rate for the whole life of the loan, and then you have the same payment traditionally for the life of the loan. It doesn't go up. Now there might be a few things that change. Like I have a fixed mortgage, but my property taxes went up. My insurance costs went up. So when I have what's called PITI, or principal, interest, taxes, and insurance, I have it all escrowed into one payment. And so I don't have the taxes and insurance separate. I have it all put into one payment, and it just makes it easier for me to just let the escrow company take care of it. But if your taxes increase every year because of property taxes, and or your insurance increases every year, your payment could still go up. But your principal and interest payments, that's what's fixed. And so in a fixed rate mortgage, your principal and interest payments are fixed for the life of the loan until you pay that thing off. Then there's something called an adjustable rate mortgage, or an ARM. Now these can be dangerous if you're not careful. If you have a fluctuating budget, if your income kind of is very stable or very fixed, you're probably going to want to go with a fixed mortgage. But adjustable rate mortgages can actually be advantageous, because if the interest rates are really low, you're going to be in a very low payment. If the interest rates are high, it could change. Now, adjustable rate mortgages can change every month, they can change every year, they can change every quarter. And so it just depends how often that's written in the contract for that adjustable rate mortgage. Now, there were some really dangerous adjustable rate mortgages back in the early 2000s that a lot of people got into. And there were even some things called negative amortization loans, and those were really dangerous. You had a very, very low payment for the first year, and then it increased over time, and by the fifth or sixth year, it could have doubled. And so be careful. Those are advantageous for certain purposes and strategies, but they're not very good if you don't have a strategy attached to why you're doing it. If you're interested in learning different strategies around using mortgages to your advantage, let me know. Put a comment below. Comment the word strategy, or I don't know, comment something, and we'll set up a time. I'll shoot you a message where we can set up a time to chat. So we've talked about a fixed rate mortgage, which could be 15, 20, or 30 years. And I've heard there's actually some that are going to be 40 years. We've talked about adjustable rate mortgages. Now there's different types of loans. There's conventional loans, which are not backed by the government. It's just backed by the marketplace, backed by the investment company or the bank that's putting the loan out. And then there's VA loans and other loans like that that are backed by the government, FHA loans, HUD loans. Those are all backed by the government. So if there's a default, the government can come in and kind of see what's going on and help you out and help you through it. And then there are jumbo loans. And right now, as of this recording, jumbo loans are right around $800,000 and higher. So if you're going to go get $1 million home, you're going to get a jumbo loan. Jumbo loans have different rules, different things to watch out for, different things to look for. I'm not going to get into that in this video. It'd be a whole video in and of itself, whole training in and of itself. I'm just giving you an overview of the major types of loans here real quick so that you have that information. One more thing before I tell you about the etymology of the word mortgage. Let me just remind you that I'm actually starting a SKOOL group, a SKOOL community, and I'd love for you to come and join me there. It's going to be free for the first 100 people, and we've got about 36 in there right now, so you're going to want to get in there quick and soon, and as soon as possible, so that you make it in there. We're going to have affiliate programs, we're going to have all kinds of education, accountability, we're training, we're going to have some great things. There's some classes, some coursework in there. It's going to be really a cool community. You're going to want to join it if you're really serious about turning your income into wealth and building a massive bank account. If you go to there will be a link in the description below, or you can just go to SKOOL and type in build a massive bank account, and you'll find my community there as well. So, all right, let me share with you the etymology of the word mortgage. So it's broken up into two words, mort and gage. Mort means dead or death. Gage means pledge or commitment. And so the original word mortgage was a dead pledge. Now they say that it was because you have a pledge or a commitment or a contract to pay this payment until the contract is dead or until the contract is completed, which kills the contract. But I kind of think, that conspiracy tinfoil hat in me says, you know what, maybe mortgage is you're pledging to make a payment until you're dead. I mean, with 30 and 40-year mortgages, I don't know if you know this, but in Japan, I've heard there are 90-year mortgages. Isn't it crazy to think about at a mortgage, 30 years from now, you could still be paying for that thing. So if you're 40 or 50, you're 70 or 80 by the time that thing's paid off. That's why a lot of people want to get 15-year loans so they can pay that off much faster. There's a lot of great strategies to pay your house off even faster than a 15-year mortgage. And actually, it's more advantageous for your budget to do it according to some of these strategies. So if you're interested in learning how to pay your mortgage or your home loan off even faster, hit me up at paris@pariscluff.com. Leave a comment below saying that you want to learn how to pay this thing off faster, and we'll connect, and I'll share with you some ideas, some strategies that you might find pretty revealing and pretty amazing. So if you've ever wondered what's the difference between a 401k and an IRA, you're going to want to watch this video. Until the next one, make sure you take time every day to turn your income into wealth and build a massive bank account. Take care.